You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 23rd of November 2024, and I'm joined today by my co-host John McEwen. And in this week's episode, we're going to be discussing AstraZeneca, Burberry, Games Workshop, Vodafone, Kainos Group, and our US company of the week is Disney. John, should I start us off with AstraZeneca?
Yeah, well, following on from Glaxo recently.
Yes, and Novo Nordisk as well.
Yeah, absolutely.
AstraZeneca have come out with their third quarter results, and their revenue was ahead of expectations, rising by 21% to $13.6 billion, including currency movements. The uplift was driven by broad-based growth across the majority of product segments. Underlying operating profit rose by 27% to $4.3 billion, with all expense lines other than R&D rising slower than revenue. Free cash flow over the first 9 months rose from 7.1 to 8 billion, and net debt increased 3.8 billion to 26.3 billion, driven largely by spending on acquisitions. Full year growth guidance for revenue and underlying earnings per share has been raised from the mid to the high teens, and the shares were broadly flat in early trading. It is worth mentioning that they currently are under investigation in China, where the regional head has been arrested. However, the launch of the investigation by the Chinese authorities into the business practices of current and former employees, not AstraZeneca itself as a company at present. And AstraZeneca is targeting 80 billion of revenue and an operating margin in the mid 30% by 2030. Cancer treatments currently consist of about a third of sales, and they're actually getting some decent growth outside of cancer now. So Ultomiris, which was acquired with the rare disease specialist Alexion, saw sales grow 35% in the quarter, and there could be further growth ahead after they've had some regulatory approval recently. Farxiga, which treats cardiovascular disease, kidney problems, and type 2 diabetes, is also growing strongly ahead of products in the same class. Net debt is around 1.4x forecast cash profits, which looks okay actually. And AstraZeneca is trading at a forward P of 14.1, has a prospective yield of 2.5%, and a 10-year forward P of 18, and a 10-year prospective yield of 3.3%. I think these are an excellent set of results actually. Because I don't really follow pharmaceutical companies, I kind of expected AstraZeneca to be more in line with the Glaxo ones and the Novo Nordisk ones, but they are closer to Novo Nordisk. They're not quite as good as Novo Nordisk, but Novo Nordisk were unbelievable. But yeah, it seems like the business is doing well. It seems like the acquisitions that they made recently are working. I'd still have the same concerns I normally have, which I won't repeat because it's probably the third week in a row that some people had to listen to it. But it looks a lot healthier than Glaxo, I think. But that is from the view of someone that doesn't know a huge amount about it. What about you, John, as someone who's slightly more informed?
I think historically Glaxo was the bigger company, and then I think actually you've seen a lot more of the blockbusters, particularly in cancer, coming out of AstraZeneca, and it wasn't that long ago. I mean, actually, maybe we're getting on for sort of 10 years, but that Pfizer came in and they offered, I think it was £40 a share, which was a significant premium. And it was rejected and, clearly undervaluing the pipeline. And then I think it's interesting to see how it has gone on in probably what was nearly 10 years ago. And Astra has continued to boom. I think what is difficult, as you said multiple times with the pharmaceuticals, unless you're really an industry expert to understand the pipeline and where future earnings are going, is very, very difficult. The consensus seems to be that Astra has a strong pipeline and has done for a long time. And I think just in following the results, if nothing else, that seems to be being borne out. But it is very difficult. And I think if you're buying a stock in if you're buying shares in a company, you do want to be able to understand that. And I think that is the limiting factor here. But on the surface of it, with the valuation that it has, it does look quite cheap, China aside. So yeah, it's interesting. I think the point that I made last time was whether you do take more of a basket type approach, but perhaps you get more of your Glaxos in that way, which is maybe not the best, but at least you're sort of de-risking in the sense that if you're not an industry expert, you're going to be getting some quality in there, and I suppose reducing your risk in that sort of sense. But no, very decent set of results here.
I think as well with a basket, if you were to take, for example, I mean, at the minute, I've only got three companies I'm aware of that would go in the basket. I suppose you've got like American ones as well, like Pfizer and stuff. But if we
Exactly.
just take the three that we've looked at, outside of a basket approach, I'd be concerned with Glaxo. Because
Mm,
although it's really, really cheap, there's quite a few worries, which is why it's so
yeah.
cheap. And then equally with Novo Nordisk, it's fantastic. And I know Terry Smith made a great argument for it last week. Not that we interviewed him, but I suppose in a sense we did. But yeah, so Terry Smith made a very strong argument when he was on last week. Yeah, I'd have concerns about the price with that one. And then you've kind of
Mm,
got Astra sort of sitting nicely in the middle. So I guess with a
yeah.
basket, it's like if you end up, for example, overpaying for a Novo Nordisk as a consequence, it's not as much of a disaster because you're going to overpay
No.
for some and you might underpay for others. So I think, yeah, I think having now done three of these in as many weeks, I don't think I'd want to do it, but I think if I were to invest in pharma, I think you've probably persuaded me on the basket approach.
Yeah. Shall we move on then?
Yes. How are Burberry doing?
So it's an interesting one. We've covered it multiple times now. Obviously, had very, very difficult times after COVID, and then it looked as though the recovery was starting. I think you were quite positive on it. But of late, and certainly over the last year, it has begun to struggle again. They had the half year results out with first half revenue falling by 20% to £1.1 billion, ignoring currency impacts. And performance in Asia Pacific was worse than markets expected, but all regions posted a double-digit sales decline. The group reported an underlying operating loss of £41 million, down from a profit of £223 million last year. That was largely due to that revenue decline. Free cash flow worsened from 15 million to 184 million due to less cash being generated from operations, and net debt rose from around 900 million to 1.4 billion. Burberry has announced a new strategy focusing on its heritage and outerwear in an attempt to reignite brand desire. No full year guidance was given, but the group plans to deliver £25 million of cost savings before the year end. And Burberry said it was too early to determine whether first half losses could be fully offset in the second half. As previously announced, dividends have been suspended and the shares were up 5.3% in early trading. In terms of valuation, Burberry has a market cap of 1.18 billion, currently doesn't have earnings, and its dividend was suspended. Its 10-year average in terms of price to earnings was 20. I think these were definitely a poor set of results. We have seen the rest of the luxury sector struggle. However, these were significantly worse than the competitors. We've talked about it before, but Burberry, it's not a super premium brand. It's sort of, I think it's probably beyond upper high street, but it doesn't go into the sort of Louis Vuitton section by any stretch. They've got a new CEO, and there's this business about focusing on outerwear first rather than the very high price points and the leather goods, which was more of the strategy before. I certainly wouldn't be buying shares in Burberry now. I don't even think, on a valuation basis, taking a punt on, I think it would be very, very risky. A lot of it is based on the Asian growth, and that traditionally this has been a very popular, quintessentially British brand, but that really seems to have been hit, and it's difficult to know how much that's going to recover by. I don't think you have the same sort of moat and the same brand appeal that you would have with the Louis Vuitton sort of stable, LVMH stable of brands here. I know that you could argue, is that reflected in the price, but it's not one that I would be touching. Sam, what are your thoughts?
Pretty similar. I don't think it's a terrible business, but I remember this is going back a few years now, but I remember when I interviewed Flosser and he said that he'd owned Burberry for a number of years and it just never seemed to be able to get going. You'd have a couple of, or you'd have a few good quarters or halves, and then it seemed to just one step forward, two steps back, and it just seems to be doing that all the time. And having followed it for a few years since then, I can start to see what he means. I think although these results are really, really poor, and they've got that free cash outflow, and they've got the debt piling up. I don't think they're that concerning in that I think it will come back. The thing is, I think it will then come back to probably, what's the word I'm looking for? Inconsistency. So I wouldn't buy it thinking, well, I think someone can come in and turn this around. I think we've seen a number of sort of management, a number of chief execs have a go at it as well. So for me, it's like, well, what would you be buying it for? I don't think it's going bust or anything, but equally, even when it's been doing well, it's never been able to do it consistently. So I don't know why you'd want to hold it long term. And I think with these retail stocks, I'm not after Boohoo and Debenhams as well back in the day. I don't want to catch any more of these falling knives. It has to be first and foremost a quality business. And I think I would rather pay for a quality business that is putting up good results. So for example, it's like I think since we last covered it on the show, ABF has had a bit of a wobble in terms of the share price.
Yeah.
But when we cover the results, it's putting up the numbers. It's growing in America. And it's been doing it consistently for a number of years. I wouldn't mind taking a punt on ABF, but with a Burberry, I don't feel the same way because I don't think it has that track record of consistency that I think I would be absolutely insistent on if I was buying a retailer now, having been burned as many times as I have in the past. Well, it's only been twice, but it's definitely once more than I should have been because I obviously didn't learn the first time. But they are bad results, but I don't think there's anything that suggests the future of the business is a concern. And I think that high-end fashion will be quite cyclical. And we have seen LVMH have a bit of a wobble.
Yeah.
The problem
Yeah.
is
Yeah.
that Burberry has no other brands to fall back on. And I don't think it was the best positioned company going into this. But equally, I think this is probably just a cyclical thing. So I wouldn't say in the long term it's massively concerning.
Yeah, and I think this is just for reference. Actually, I've just had a look. It's worth mentioning. Shares are about the cheapest they've been in 14 years.
Right.
Yeah.
I'm still not buying, but I'll just have a look at the share price because I've only looked at the PE. Oh wow.
Yeah.
I still wouldn't buy it.
No, no, no.
I've had enough of these falling knives.
Yeah, that's right.
Are you gonna be
No, no,
moving
no, no,
your
no, no, no,
boohoo
no.
money into it?
Absolutely not.
You could
Absolutely
make your
not.
money back.
No, 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 thank you.
So should we move on to a much better business?
Yes, no, absolutely. Take us away with Games Workshop, Sam.
Did you ever buy shares in Games Workshop?
No, and I don't want to hear these results, but go for it.
So this is going to be short and sweet. There's not results out, but they have come out with another trading update since the last update on 18th September. And the group, this is very short, by the way. So the group is pleased to announce that trading since the last update on 18th September 2024 is ahead of expectations. The board estimates of the results for the 6 months to 1 December 24 at actual rates is core revenue of not less than 260 million. And that's up from 235.6 million a year ago. So that would be revenue growth of 10.4% and licensing revenue of not less than 30 million. That, however, is up from 13 million a year ago. So that's up 130%. The group's profit before tax is expected to be not less than 120 million, and that is up from 96.1 million a year ago. So that is up 24.9%. And they've said further details will be announced in the half-yearly report, which will be released on 14th of Jan 2025. I think this is excellent. There's not a lot to go off here, but the core revenue, absolutely fantastic, up 10%. Not massively surprising. I think when we've gone through the actual results in more detail in the past, when you look at the potential for overseas expansion, I think there's still a lot of growth potential in like America and Asia. And I think as well, I think that licensing revenue up 130% is just absolutely fantastic. Because I think the core business, you can make a very strong argument at the current valuation, just based on that core business. And the licensing is almost a bonus. But it's now looking, we've got the Amazon show, which we've talked about, with now you've got this 130% increase. And it's getting to the point with the licensing where you can maybe look and say, well, actually, this could become a very, very significant driver of revenue going forward. So, and then a lot of the licensing is just pure profit as well, which is the other bit. It's just much higher margin because you don't have to do a huge amount. So, yeah, I think this is fantastic. And sorry to tell you, John, but the shares were up about 16% on this announcement. So they're now at an all-time high of £137.50. I think it's like a forward PE of 30 this puts it at, which I think you can make an argument for a business of this quality. And I think as well, the market cap is still only 4.5 billion. I don't know how big it could get is the thing, but I think it could be a lot bigger than 4.5 billion. But yeah, as a shareholder, I'm very happy, very excited to cover these results when they do come out. So it'll probably be in January that we end up covering it next. But Very, very happy. John, what are your thoughts?
Yeah, you've said it all.
Okay, we'll not dwell on it.
How much are you up personally, Sam?
So I think I initially bought at about £100 a share.
Hmm.
And then it had a bit of a wobble like a year and a half or so ago from
Yeah.
memory. And it went down to about 60 and I added quite significantly. But I'm now up on both tranches actually. But overall, I'm up 65% now.
Oh, very nice. Very
Yeah.
nice.
And it's a business that I do like as well. I do like the business. It's quite nostalgic, but yeah. Would you consider getting into it?
Possibly. And I'd have to avoid, being anchored at those prices that you said that you got in at and that we'd covered them at. But I think,
Yeah,
as you
but then
say, there's a lot for the business going forward and a huge amount of growth potentially ahead of it. So,
see, anchoring was, if you go on the share price and go on like a 10-year graph, though, anchoring was a huge problem for me because I remember I looked at it for years before I bought it. I
yeah,
think it was about 1,500 a share
yeah.
when I started. 1,500, what would it have been? £15 a share.
Yeah,
And I ended up first buying in at 100. And I just
yeah,
kind of watched it go up and up for years. And I just never bought it, even though I always
yeah,
really liked it. So sometimes you've just got to bite the bullet. But
yeah, absolutely.
fortunately, I did get a chance to get it at around kind of 60, 70. But yeah, it's a difficult one because it's just the growth in the last 10 years is absolutely unbelievable. They've done a really, really good job with that business.
Yeah, very
What have
good.
we got next then?
We've got a business that's been delivering less growth and much more mature in that sense. It's Vodafone. We have covered it on the show before. They have their half year results out with first half revenue growing by 1.6% to 18.3 billion euros. Service revenue of 15.1 billion euros was up 4.8% on an organic basis, with an anticipated slowdown in Germany offset by growth in other Europe, Africa, and Turkey, and underlying cash profits saw organic growth of 3.8% to 5.4 billion euros as a result. There was an adjusted free cash outflow of 950 million euros compared with a prior year of 1.4 billion euros, and net debt dropped 12% to 31.7 billion euros. Following the sale of the Spanish and Italian businesses, the capital return policy has been right sized. An interim dividend of 2.25 euro cents was declared, prior year 5.5 euro cents, and the board is now targeting 4.5 euro cents for the current year. 1 billion of the 2 billion euro share buyback program following the Spanish sale has been completed, and another 2 billion is going to be returned next year upon completion of the Italian sale. There were no changes to the full year guidance of around 11 billion euros in underlying cash profit and at least 2.4 billion euros of underlying free cash flow. The shares were down nearly 4.5% in early trading. In terms of valuation, Vodafone has a market cap of £18 billion and trades at 9.6 times forward earnings, compared with a 10-year average of 20.3, with a prospective dividend yield of nearly 6%. I mean, I thought these results were okay. I think we have seen this company struggle, and there is to a degree a recovery going on. It's clearly a mature business, high capital expenditure. I mean, they invested more than 20 billion euros in the German market, but still struggling to grow revenue and customer numbers there. They are reducing costs, more job cuts coming through, and they're also looking towards a merger with Three pending regulatory approval. They do have Vodacom, which is a subsidiary, and that operates in the growth markets of Africa with mid to high single digit cash profit growth. But that's not a large part of the business. I know we both hold Airtel Africa, and I think that has the better things about a telecoms business. Obviously, it's much more risky in terms of the region that it operates in. But I think with Vodafone, yes, I suppose the valuation is cheap, but it is sort of cheap for a reason. It's not really growing, and it does have very large costs, and there's a significant amount of debt on the balance sheet. So it's just not a business that I would be interested in investing in. I don't think that it has many prospects really going forward, so it wouldn't be one for me. I can see some income investors might be interested just because it's got that decent dividend yield, but as I say, not one for me.
I don't really have a huge amount to add to that. I think the debt's quite high, but it's probably not that concerning if they're selling off low performing chunks of the business, because that can soon come down if they do that. So probably the debt's not massively concerning actually. But yeah, thing is, even if they sell that, I guess they might be left with higher growth areas like Africa and Turkey and stuff. But yeah, like you say, it's just such a saturated business, such a difficult environment. I think I'd rather have exposure to just the pure African side of it in Airtel. I wouldn't, I'm never going to be sat there thinking, how can I increase my European telecoms exposure? It's such a saturated market and it's so difficult. I don't, I don't think Vodafone's a terrible business, but I just think it is so mature that, like you say, unless you just want it for the income, I, I don't think I wouldn't buy this for growth anyway.
I mean, over the last 10 years, shares are down about 70%.
I'm assuming that dividend must have been slashed at some point then.
Yeah, it's a good point. I'd have to look back into that, but yeah,
Because I think it's always been quite high income, so it must have cut the dividend at some point. But it's not
yeah.
worth looking into is the problem. You're just never going to buy it.
But interestingly, in the growth years were, if you look from 88 or 89 to 1999, so just before the bubble burst, it was a 27 bagger.
Oh, wow. Oh, I didn't realize this was a .com stock.
Yeah, well, I guess it was on the
I suppose
back of
everything was.
yeah, well, exactly, exactly. But we've never reached those heights again, sadly.
So, in that case, should we move on to a debut for the show?
Absolutely, Sam. Take us away.
So, this is Kainos Group, which we've never covered, nor had I ever heard of. So, Kainos Group, for those who, like me prior to today, are totally unfamiliar, and this is just from their website, so do bear that in mind. We are a UK headquartered IT provider with expertise across three divisions: digital services, workday services, and workday products. Our purpose is to help our customers with their most challenging projects, and together with our partners, help them build the capabilities to succeed in the digital age. Our digital services division helps our customers to solve their business problems by using technology, enabling them and their users to work smarter, faster, and better, working collaboratively with public, commercial, and healthcare customers around the world. Our innovative and transformative solutions are secure, accessible, cost effective, and take a user first approach. We leverage the benefits of public cloud and enable customers to utilize their data to drive decision making. So that's digital services. Workday services. Our Workday services division specializes in the deployment of Workday Inc.'s finance, HR, and planning products to leading organizations across Europe and North America. We're one of Workday's most respected partners and experienced in complex deployment and trusted by our customers to launch, test, expand, and support their Workday systems. Workday products. Our Workday products division develops products that complement Workday. Our smart product suite, including Smart Test for automated testing, Smart Audit for compliance monitoring, and Smart Shield for data masking, are used by more than 350 customers globally to safeguard their Workday systems. So they have 1,022 global customers, and they've come out with their 6 month results even for they've come out with their 6 month results for the 6 months ended 30 September 2024. Revenue was down 5% to 183.1 million. Statutory profit before tax was up 11% to 34.2 million. Diluted earnings per share was up 15% to 20.1p a share. Adjusted diluted earnings per share was up 2% to 22.5p a share. Interim dividend per share was up 13% to 9.3p a share. Bookings were down 11% to 179.5 million. Products annual recurring revenue was up 18% to 65.1 million. Contracted backlog was up 8% to 354 million. Cash was up 34% to 151 million. And they've said the revenue decrease of 5% reflects the tougher trading environment in services, as referenced in our recent trading update. But our disciplined execution and strong growth in higher margin products have supported profitability. They said the board's announced an intention to launch a share buyback scheme of 30 million to be executed over the next 6 months. And they've said Workday related products continue to grow strongly and now account for 19% of group revenue, and that's up from 14% a year ago. Our enhanced partnership with Workday underpins our 100 million 2026 annualized recurring revenue target. So that's 100 million, and that's currently at 65 million. And they've also got a new 2030 target of 200 million. So that's 65 million to 200 million. And what would it be? 6 years. And the overall revenue currently is only about 183. So that would be pretty decent, actually. Workday product revenue was up 28%, and that's 28% organic to 34.3 million, with annualized recurring revenue increasing by 18% to 65.1 million. Digital services revenue decreased 11% to 97.3 million. And they've said despite sustained public sector demand, the hiatus following the UK general election has delayed project mobilisations, with public sector revenue falling by 15% to 62 million. Within the healthcare sector, strong revenue growth of 16%, resulting in revenue of 23.6 million. That's up from 20.4 million a year ago. Commercial sector revenue continued to be affected by the lackluster economy, resulting in delays to customer investment decisions, and was 27% lower at 11.6 million. In terms of the valuation, the business trades at a forward PE of 17 and has a market cap of just over 1 billion with a dividend yield of 3.29%. I think this is actually quite an interesting business. I don't necessarily understand the core business that well. However, I think we did actually, this is going back years, I think we did cover Workday once on the show as a US company. I don't remember anything about it, but I think we've covered it. But I think Workday sounds promising, and I think that pivot does seem like the right one, especially if the legacy business is declining. You can see the growth in Workday is quite encouraging. It's higher margin. I think those targets, if they can hit them, would put the business in an excellent position. And based on the figures that Workday is currently doing, or the Workday part of the business is currently doing, I don't think it's unreasonable. The issue I would have is Workday is now 19% of revenue. I'd need to look into and I'd need to understand how much security they have. If Workday decides to drop them as a partner and they've hit those targets and it's now 50% of the business, what happens? So that would be a huge risk, and that's a risk that will increase because they're basically pinning their future to the future of Workday and almost working as like Workday's UK subsidiary virtually, which I think there's an opportunity there, but it is risk because they're putting all their eggs almost in this Workday basket, and I don't know how much control they have over this partnership with Workday. But I think it's an interesting business, and it's not the type of business that we normally see listed in the UK. So I think I probably would be interested in coming back and seeing it again in 6 to 12 months. And I don't think the valuation's unreasonable if they can hit their target. Maybe the valuation's a bit lower, partly because it's listed in the UK, but also because you have that huge concentration of risk in Workday. What do you think, John?
I think you're right there. And Workday is a much, much bigger company. It's got a market cap of about 70 billion. Interestingly, they have their results out later this week, or sorry, early next week. So we might be worth us covering it next week and just seeing how Workday is done. That would be my main concern with this business, and I think it's that reliance. And then the rest of the business, what are you then left with? It's put up some very good numbers over the last few years, but it's that concentration of risk. And would you just rather own Workday? I think that would be the issue for me.
Well, I think yeah, it does make sense to probably have a look at Workday and possibly cover it next week. But I suspect if you want to own Workday, you won't get it at 17 times earnings.
No, I
And
think
also,
it's more.
you might not get the same growth. Because if
Yeah.
they're kind of driving that, if they're piggybacking off it, the opportunity for them might be a lot bigger. But I think from a management point of view, I think it's similar. I mean, I don't really understand the legacy business, I'm going to be honest, but it sounds similar to the legacy business. But, they've recognized the decline, and I think management have tried to pivot. And I don't think the pivot is an obviously stupid one. It has its own risks because of the concentration. But I don't think it's terrible management. I think it's quite a good idea.
No, fair enough. Fair enough. Well, it'll be an interesting one to cover over the next couple of years, I think.
Shall we move on to another business that we have been covering for a few years
Yes,
now?
absolutely. So it's one of our favorites. It's Disney. They had their fourth quarter results out last week, with fourth quarter revenue growing by 6%, $22.6 billion, And in the entertainment division, declines in linear or traditional networks were more than offset by double-digit growth in the direct-to-consumer content, which includes Disney's streaming brands and Disney Plus. Experiences, which includes the theme parks, was up by just 1%. Operating profit rose by 23% to $3.7 billion, which was ahead of market expectations, and subscriber growth and increased advertising revenue helped profits more than quadruple in the entertainment division. This offset mid-single-digit declines in sports and experiences divisions. Free cash flow rose 18% to $4 billion due to much higher levels of cash being generated from the business. And net debt rose from $32.2 billion to $39.8 billion. Disney expects underlying earnings per share to grow at high single-digit rates in 2025 before accelerating to double-digit rates for both 2026 and 2027. And the group plans to complete $3 billion of share buybacks this financial year. And the shares were up 7% in early trading. In terms of valuation, Disney has a market cap of $206 billion and trades at 19.7 times forward earnings, compared with the 10-year average of 23.5, and it has a prospective dividend yield of 1%. I thought this was a very decent set of results with strong growth from Disney Plus, park business more or less steady, and a decent showing at the box office with Inside Out 2, Deadpool and Wolverine, and the Disney first studio to cross the $4 billion mark this year. As we've said before, it's got that hugely valuable IP and the exciting growth story in the form of Disney Plus. I don't think for the quality of the business, it's expensive at just under 20 times earnings, but it's not what you consider cheap. It does have those more mature businesses in terms of the parks, and a lot of the investment case is pinned on having that stable of IP, but also the growth that Disney Plus is delivering. And certainly if you compare it with Netflix, and I think we've done this plenty of times, it's got those added divisions so for a bit more stability and that very valuable IP with a class-leading streaming service, which is yet, I think, to reach the full profitability that it will do in the future. It is now profitable, but there's still, I think, a lot of growth potential ahead there. So I'm very happy as a shareholder, and I think that the shares are probably fairly valued, actually.
I'm also very happy. I think we'd seen a bit of a wobble with like the Disney Plus numbers, but that was because they'd made the conscious decision that they were going to start raising prices, which I think we kind of both agreed was the correct decision longer term. And they are now, possibly for the first time since they launched Disney Plus, actually starting to see the benefits of it in terms of offsetting some of that decline in some of the more legacy businesses. But I think this is an excellent set of results, and that's mainly because it's the first set of results where it seems like the direct to consumer has actually been a huge contributor rather than them having to make this investment in it. So yeah, I'm very happy. I agree with the valuations, probably pretty reasonable. I'd obviously like to see it at a higher valuation as a shareholder. However, I think it needs to put up a few quarters of this, and if we can start to see, the direct to consumer really pumping out some good numbers with some consistency, I think it would have the potential for some kind of increase in the multiple, actually, or if not, at least very least the increase in the earnings. But it's been a bit, I think, since in the time we've owned it, it's been a bit lackluster. It's been kind of up and down. But I think for me, I have always had that long-term belief that Disney Plus could be absolutely huge for this business. And I think hopefully we're now starting to see that. So yeah, as a shareholder, I'm very happy, and I'll certainly be continuing to hold.
Very good. So, Sam, of the companies this week, what would be a top pick and what would be last?
Ooh,
Difficult.
it is difficult because I think it might be the first time we've had Games Workshop and Disney together.
Yeah.
Normally one of them's an easy winner. I think probably for me, I think it would be Games Workshop. I do love Disney. I think it's a fantastic business. I think these results are really good. But I think with Games Workshop, because of the size of the market cap, I think there's a lot more potential for returns there. I think there's just more growth potential. There's more levers they can pull. Whereas Disney's obviously much more mature. Least favorite, I think it would probably be Burberry. I think those results from a retail business, I just wouldn't touch it. What about you?
I would Games Workshop. I'm torn. I'd probably go with Disney as my first pick. And then last, it's not a badly run business, but I'd probably go with Kainos, and that was just because of the reliance on Workday. That would just
At the minute,
unsettle me
though,
a
it's
bit.
only 20% of revenue.
Yeah, yeah,
I
but
don't,
I
I
think
don't,
that's
obviously it's your
yeah,
decision, but
yeah,
would you rather have
yeah.
Burberry in your portfolio than Kainos?
Well, not really. It's there are two down there, and well, in fact, there are three down there. But I can, Vodafone, things are broadly steady, and it's paying a decent dividend. Kainos and Burberry, neither are businesses I'd like to own.
I think with
But
Vodafone, if you told me whether you like it or not, you're going in Vodafone all in for 10 years, I'm like, oh,
yeah,
I'm not thrilled about that. But if you told me I was going all in on Burberry or Kainos, I think with Burberry, I'd probably be the most concerned after well, at
yeah,
least with Kainos, there's still like a decent legacy business there.
yeah. I don't know.
Okay,
Neither for me, Sam.
right. I think that's everything in that case.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.